Hello and welcome to our ValidMind webinar, Driving Compliant AI Innovation in Financial Services. I'm Kevin Allen, Head of Marketing for ValidMind, and joining us today is a special guest, Ken So, founder and CEO of Flowcast. And leading today's conversation is Jonas Jacobi, CEO and co-founder of ValidMind. So without further ado, I'll hand it over to Jonas to get us started.
Thank you, Kevin. It's good to be here. Hi, Ken. It's great to see you. It's been a while. How are you doing?
I'm doing well. How are you, Jonas?
Yeah, not too bad, not too bad. Can't complain. Living in California, so weather is good. So this is super excited to have you on board this webinar. Looking forward to the conversation today. So why don't we kick it off? Just Ken, why don't you tell us a little bit about your company and what you guys are doing?
Yeah, absolutely. So Flowcast, we started in 2016. So it's been roughly over 8 years now. And so we've seen all the cycles and where things have kind of moved in the world of AI for financial institutions. But what we do is we help financial institutions in automating their credit decisions and risk monitoring primarily for their loan products. We deploy and manage proprietary machine learning models for these clients, and we leverage primarily transaction data and complementing more traditional kind of credit scoring models. Our target audience is primarily in small business lending to fintechs to big banks, leveraging their own transaction data, and even corporates that are looking to risk assess their end clients. And lastly, we have partnerships with CRAs such as Experian and others like MasterCard.
Oh, wow. That's an amazing journey you've been on. Congratulations. So we're here today to talk about AI innovation and also how that impact, in particular, financial institutions. So how do you see, from your perspective, dealing with a lot of these institutions, how do you see AI transform the way that institutions assess credit risk, which is obviously your primary solution here? How do you see AI sort of advance or help them in their ability to do so?
Yeah, absolutely. So maybe I'll start with a little bit of context since we, started in the early days of AI when it was still called big data and data science, and I would say there's kind of three pillars of evolution that happened during the past 10 years or so, and the first of which is the movement to the cloud, and as we see, a lot of the big banks are starting to shift from more traditional kind of enterprise servers to VPC or to the cloud. And that started primarily in 2010s, early 2010s. And by the mid of 2010s, a lot of their internal data and processes have moved to private cloud. And that really enabled and then allowed a lot of kind of AI type solutions to start, whether it's more on the client acquisition side to risk assessment and credit decision, because having that data to the cloud allow us to get access to the much more higher quality data much faster and easier. That's probably the first driver. The second drivers are a lot of the toolings that happen over the years, such as things like Plaid or MX or Yodlee, that allow others to get permissible customer data of the bank accounts, looking at the balance, what is the cash flow, inflow and outflow of the cash flow, to more advanced type connectors like accounting software connectors like Kodak that you can now tap into a small business accounting and financial statement, to the payroll and to things like e-commerce platforms like Shopify and Amazon. All that kind of enable the access to data to allow us to build these advanced models. And then I would say lastly, the last wave happened to be during COVID, surprisingly, when everything is all completely digitized and no one's going to the bank anymore, and you have to be forced to submit your your application if you're applying for a loan, all digital. And things like PPP came along, and that really accelerated the adoption of having this movement towards digitization, and therefore allowing us to build these models. Those three combination, I would say, really allow AI adoption to happen for financial institutions and beyond.
So have you seen that accelerating, like the adoption in general accelerating over the past couple of years? And what have you seen as sort of the key advancements in that particular space?
Yeah, the key advancement happened to started with a lot of the fintechs. Beyond just the traditional credit models that's typically used for loans and for credit cards and so forth. We see new products like peer-to-peer lending, to buy now pay later, to earn wage access. Those type of products allow in a lot of innovations that happen with as it relates to credit decisions and monitoring. And that really kind of forced a lot of the bigger banks to adopt new ways of looking at risk. And to your earlier point, regulations and compliance does play a role in kind of having these kind of speed bumps, where there needs to be a balance between adoption of new products to safety and fairness to the end customer. But I think there's that kind of the tailwind had been a lot of the fintechs really kind of taking the charge and leading the way in how we look at things around kind of credit decision and credit risk.
So I mean, you've been in this for a while, and so what do you hear from your financial services clients, about their adoption of AI and or AI solution or AI based solutions? Mm-hmm. And what are the hurdles they face as they're talking to you and your company?
Yeah, I would say there's two hurdles. The first is just getting data, and big banks have lots of data. They have been accumulating a lot of data since the beginning. The problem is a lot of data is sitting in silos. They're all over, they're all over the place, and a lot of people don't even know what they there's no common data dictionary. So there, people move around, they change jobs. So a lot of that knowledge gets lost, and just getting access to that data has been a big challenge. And for us, our biggest thesis is that we're leveraging transaction data to make credit decision, and that transaction data is probably the hardest to get, even though they exist and it's in a huge amount. But getting access in a reliable way and in a continuous way was biggest hurdle for primarily 80% of the banks that we work with. And the movement to the cloud, that did help quite a bit to alleviate those concerns. And but a big part of deploying model in production is exactly what ValidMind is doing and helping is that process of assessing whether that data quality is there, the completeness is there, and all the various metrics that we have to look at during the whole model validation process, and to validate whether that data can be used for things around credit decisions and risk monitoring. The second hurdle, I would say, is during that process of model validation, the same standard had been used for traditional kind of rule-based model are being applied for AI models. They've been working with the regulators for literally decades on model risk management, and there's a very mature set of principles and best practices and in identifying risks of these, with model development and model use. And they're not going to change that on a dime. They may expand it for AI, but a lot of those principles will remain intact. As a result, we're applying very rigid type process to something much more different and fluid, and that creates a huge challenge for us as model provider. I can share, like, a lot of our data scientists probably spend 80% of the time in the model validation phase than the actual model construction, and it is a huge kind of burden on the on the provider side, and to be able to kind of provide that. And so we have to streamline our workflow to make that happen, in terms of how do we make the model documentation much more adaptive and responsive to things like ad hoc requests or analysis that comes up that during that whole phase. And it could, like, we've seen it's as rigid as one single model had 20 findings, and we had to perform analysis on each of those sort of findings, whether it's something that's easy to do or hard. And so we spent a lot of time having to juggle through all that, and that creates a big barrier in terms of model deployment.
Yeah. So coming back a little bit to your points about the challenges of getting data and sort of the quality of data. How do you address some of the challenges of managing and leveraging these large data sets that the banks have to ensure that your models are reliable and, to your point earlier, fair to consumers?
Yeah, absolutely. I think there is a bit of a balance in how we leverage the internal data that we get from the banks to derive the model that is the most accurate out there. But at the same time, I will give one example. So we started with one model where we had over 250 fields, and we get access to a ton of data, and then we generate a lot of derived data based on that. So we had over 250 fields, but to validate every single field was just way too kind of time consuming, and to kind of provide the evidence to show all the kind of key metrics. So we ended up with paring it down all the way down to 20 in order for us to make that balance between proving out all the various kind of dimensions. And then we had, obviously, by paring down to 20, we had to sacrifice some accuracy. So there's a bit of a give and take to kind of be able to balance out kind of data quality and completeness versus what kind of accuracy we wanted to achieve.
Yeah.
In terms of the data quality, there's that's where there's like kind of 5 dimensions typically that we need to adhere to. I think the biggest barrier has always been kind of what we call the labels, and the labels are those that like for lending, especially, where default risk is typically in a it's low single digit, or depending on what type of lending product. So it's a very imbalanced data set, and getting those labels of bad outcomes are kind of the crown jewels for a bank, right? Like, they have to build years of a loan book in order to see enough of those bad outcomes, and those bad outcomes are being used to to help derive your prediction in the model. So getting those true labels is the hardest to come by, and how do we kind of balance out those 5 dimensions in terms of validity and completeness and accuracy and so forth. So that's been kind of where we spent a lot of time in doing.
So if you're looking at you have your proprietary machine learning models. If you're looking at the industry going forward, we see obviously an increasing complexity of AI models as well. I mean, one of the things that are coming out now and being adopted is Gen AI. How do you make sure as a company selling into the banks that you stay on top of the increased complexity, obviously, and making sure that your models are reliable, but how do you ensure that your stakeholders, your customers and potential regulators are happy with the level of compliance that you offer to your clients?
Yeah, that's a good question. So as a fintech, with limited resources, it was difficult to to adopt, and adhere to a lot of the regulatory kind of compliance. So we did have to kind of bite the bullet in bringing on board a compliance officer early on to help, shore up our policies and so forth. So one of the things that we've done is really up and down the organization, we made compliance a key, kind of value for us, so that we need to adhere to in order for us to service our clients. And it's not something that, we can kind of get around, like any sort of startup. So that is a core kind of value that we had to adopt early on. The second I would say is we did have to depend on a lot of kind of third party providers to help us shore up. For example, we early on we adopted a tool called Tugboat, which is now part of OneTrust, and that really helped us streamline our things like our policies, our controls, or showing evidence. And getting these large clients, we do need to show a lot of and be able to respond to a lot of those questionnaires around InfoSec and adhere to a lot of these type of audits, not just with clients but also with our investors as well, as they look at how well are we we SOC 2 compliant and so forth. So that's sort of some of the things that we did pretty early on, even before having clients. And I would say, like with Gen AI, especially leveraging external models, that's going to be even tougher. The question is going to be, do you see third party, providers like an Anthropic or OpenAI going to adhere to opening up their books and allowing a bank to go through? That's something I don't think is going to happen. But for us, in order for us to win a lot of these accounts, we had to go and open up, these are our controls and policies in place, and be able to adhere even before an NDA. They wanted us to kind of show all that before even just a trial. And then lastly, I would say, having guardrails in place that we can show that combination of machine learning models and traditional rule-based models can coexist. And so things around like knockout rules that we implement, that those generally will have to be in place before deploying any models to adhere to the compliance.
Yeah. So I mean, so we're getting into that space around AI regulations and innovation, right? So do you get any requests from banks on the regulatory side for the adoption of your solution that has machine learning algorithms embedded in it?
Yeah, so I think there's that perception that machine learning models are a black box, they're opaque, and that's to overcome that. That's where the model validation is hugely important. How do we turn something like an XGBoost model into something that's completely transparent? And so if you remember, our model documentation is over almost 200 pages long, and we really scrutinize on every single input, even if it's just a 20 field type model. We scrutinize on every single field, scrutinize on shop, when we look at the explainability, and so every dimension we look at pretty precisely to make that perception of a black box completely transparent. So that's kind of one thing that for AI adoption to happen, everyone needs to be completely transparent on what's being deployed. And there are techniques now that's much more easier to do now than, I would say, like 5 years ago. to show those, not just job, but also things like confidence level in the prediction, and so various techniques to make it much more easily digestible. But I would say there is that human aspect of responding to the model validators' requests, in an expeditious manner. I think that also helps with confidence that these models are indeed, that can be adopted, and that's where streamlining that model validation is pretty helpful.
Yeah. So do you, so when we look at the AI landscape, right? It's especially the regulatory landscape around AI is evolving. I wouldn't say at lightning speed, but it's evolving. From a governance perspective, fairly rapidly. What do you think would be the top next steps for other companies to look at in terms of staying ahead of sort of these potential regulatory compliance that might come in from either the U.S. federal government or state governments? How do you recommend them to? What's your recommendation to make sure that they can also be successful in building that trust with their clients?
Yeah, so I think the biggest kind of regulatory change that's coming down or already has happened is the CFPB 1033 rule, which basically mandates banks to allow consumers to have right to their access their financial data, making open banking much more accessible. And open banking has been around, obviously in Europe, driven by regulatory regime, but in the US, it's always been market driven. And the challenge always been in the US, where you got close to 5,000, financial institutions, from the credit unions to community banks to the big banks. It's difficult for them to build an API to allow someone to go and get access to the data, and hence, MX and Finicity and Plaid exist today. Is these aggregators, whether they do screen scraping or whatnot, allow access to that data. So I think with open banking, slowly we'll see more adoption of and acceptance of access to permissible, bank data, and which entails that we'll enable that really enabled us to do better credit decisions, because the background of credit decisions is that it's always been FICO in the US. It's always been FICO driven for consumer lending, but FICO is somewhat of it's been around since the 60s, and it's been great, but it's still a lagging indicator. If you have access to your bank accounts, seeing all the cash flow inflow and outflow, that's in real time. Somebody loses a job, you can kind of see in real time whether that poses a credit risk for the lender, and that's it is an obvious kind of data set that you want, but it also enables lenders to have much better assessment of the client and get a much more real-time picture. And it also avoids a lot of the fraud issues that exist today, especially with the new all these kind of new fintechs that are kind of skirting a little bit around, whether it's buy now pay later or some of the credit building products. So I think there's going to be a good balance between reducing fraud, but also having a robust kind of lending products out there, and therefore the market will move more and more towards the adoption of more advanced kind of AI type solutions as it pertains to kind of credit decisioning.
Yeah. So what do you think looking ahead, sort of trying to wrap up here, but looking ahead, what do you think the next wave of AI-driven innovation will look like in financial services? What's your if you envision the next, say, 5 to 10 years, how's that going to look like?
Yeah, I think obviously, most people are very excited about Gen AI in financial services, and we're seeing use cases around productivity gains that are massive, right? 10x, even more than that on a lot of the kind of the workflow that exists, to things around even like wealth management, doing things around kind of estate planning and so forth. I think that obviously a lot of people are excited. I'm excited about that. But things that people don't care to talk about enough is around how do you get these things to be compliant, and especially if you're relying on commercial LLMs, and avoid things like systemic risks, avoid things like, kind of how do we protect consumers and protect their privacy, and how do we know these models are sound and fair and transparent, and it's going to be that, enabling that is actually what people don't generally think about, and that's where I think things around building expandability and biases and handling these kind of model validation of external LLMs are kind of the interesting bit that I'm excited to see where that leads. But I think there needs to be kind of innovations on both sides to make it happen for financial institutions.
Yeah, I'm with you on that. Ken, this was an amazing chat. I really enjoy this. Great to have you on board our webinar. And I look forward to continued collaboration with you and your team. And we'll hopefully get you back on here to talk more about AI and AI innovation.
Absolutely. I enjoyed it as well. Thank you, Jonas.
Thank you. Kevin, back to you.
All right, Ken, I echo that. Thank you so much. And thank you, Jonas, for joining us today. For those of you who are interested in learning more, you can learn more about Flowcast at flowcast.ai. You can also request a demo of the ValidMind platform at validmind.com. Stay tuned for our next webinar in our Valid Thoughts series. That'll be coming soon. Thanks, everyone.